We are now in quarter four and we are trying to skillfully adjust our action and strategy. Let me bring back the mental discipline of marketplace because it's now the real first time of business performance feedback, which of course drives the adjustment of your business strategy. And at this point, really every single item on this chart is going to be contemplated. The first thing you really need to do is you need to look at quarter three results and conduct a strategic analysis. Check your financial performance, customer reactions, employee reactions, your production operations. Check out what your competition is doing, what brands, which markets, which target segments they follow. Check out your overall performance and see whether it is as expected or whether you got a surprise in regard to the demand in quarter three, and if you got a surprise in some of the reactions of the customers to your design. As I said before, the goal for quarter four is skillfully adjust your strategy. That needs a brand design and price analysis, an advertising analysis, sales management, production plan, compensation analysis, and your finances, which are hopefully healthy based on having run the simulation in quarter three. And of course, based on the analysis, you will make your changes and feed them into marketplace. To check your overall performance, you can check the balance scorecard. I mentioned this before in one of our first mini lectures, and I will be going into detail here. The checking of balance scorecard is, of course, at this point only a start, because your balance scorecard will only count starting from quarter 5 to quarter 8. But it might give you some indications on where you need to improve. You also need to look at your market demand and market share, as well as your overall financial performance. The balance scorecard will, of course, be found in the simulation. It's the first time that you have a performance report, and under the performance report, you actually see your results. So if you go into your web team shell, you'll see on the left-hand side, under the third item from the top, performance report, and once you click it, it opens up, and the fifth item from the top is the balance scorecard. You see results for quarter three for the industry. You're getting an explanation of what total performance means, and you get for each of the areas, marketing, finance, etc., a specific information on what drives the number that you received as an overall performance for the area. And you see underneath in the gray shaded field that each score in the balance scorecard is driven by very specific levers. That's important because these levers will actually be very much related to what you decide, and therefore will give you an operational opportunity to manage your financial reporting as well as your balance scorecard for each of the fields. The fields, as I said before, include financial performance, market effectiveness, marketing performance, investments in the future, creation of wealth for your shareholders, financial risk, your asset management, your manufacturing productivity, and your human resource management. Don't get caught up in market share and short-term profits. Look at the long-term viability of your firm, and the balance scorecard is trying to push you towards looking at the long-term viability, as it measures both the short as well as the long-term scores. And as I said in my beginning introductory remarks, we would like to make sure that you are having skills of a general manager, knowing many parts of the holistic organization. The action potential for the firm based on the balanced scorecard are, of course, financial decisions, manufacturing decisions, marketing decisions, sales decisions, and advertising decisions. All of these are multiplied by the scores and are then driving the overall score. Remember, only quarters 5, 6, 7, and 8 count for the scorecard. So don't be dismayed by what you receive in quarters 3 or 4. Just make sure that you're picking up the slack, change skillfully, so starting quarter 5 you have good balanced scorecards. Let's go into detail. So the measures of customer satisfaction, for example, have 3 items: brand judgment, price judgment, and ad judgment based on customers' reactions. 100 indicates that's perfect, and 70, for example, in brand rating and ad rating would be pretty good for the first quarters 3 and 4. Only in quarter 5 will you be able to invest in new research and development to improve the brand design substantially. So if you're coming up with the 70 of brand judgment and ad judgment in the beginning through 2 quarters of 3 and 4, you're going to be all right. Pricing is another story. Customers are really rational, and they feel, because of the other brands in the market, if a product is overpriced. So to make sure that you're really creating value for your customers, you should try to be as close to 100 in price rating. Your goal in quarter 4 is to monitor your customer satisfaction, making sure that you give what the customer wants. You're going to communicate your benefits clearly, and of course, you're trying to do this better than the competition. Remember, we are trying to deduce the marketing or the response functions for our marketing actions. That includes not only design, but also pricing and advertising decisions. Don't waste money when it's a U-curve, but don't underspend so that you don't have any effects in the market. All right, so when we talk about marketing tactics, you need to really skillfully adjust the marketing tactics and look at the formula. You can revise brand designs and create new ones. You can revise ad copy. You can adjust prices. You can hire more salespeople, or you can deploy them differently in different regions and different sales offices. And you can adjust or expand your marketing on the web. Adding or taking away relevance to find the sweet spot in the customer's response function is your goal for quarter 4. Next, we need to look at competitive benchmarks, and that would be our strategic analysis of the market. Look at what the competitors are doing. Look at their brand and ad designs. Look at their prices. Look at where they put the priorities in regard to their sales offices. Look at their channel strategy, whether it's brick and mortar or web-based. Look at their staffing. Look at their ad placements as well as the ad content. Look at what demand they generated by brand and segment. These are important benchmarks for your goal of figuring out how you stack up to your competition. And therefore, you could, if you do the analysis right, reverse engineer the strategy for each of the competitors. Determine who is a threat and who might not be. Determine the strengths and weaknesses of the competitors. Try to emulate good decisions where your competitors do better than you. And also predict the direction of competitive moves. If you are doing better than others, you can be sure that your competition will copy you. And as a consequence, adjust your strategy and tactics as a reaction to competitor strengths and weaknesses and in anticipation of their future moves. Believe it or not, human resource performance is very important. As I said before, employee satisfaction drives productivity, and of course, competitive compensation packages drive satisfaction and therefore drive the productivity of your people, which also translates, if you can, in lower discounts for operational effectiveness. The goals for your human resource management are figuring out which elements of your package, which elements of your benefits package seem to drive the employee satisfaction the most. And also try to predict how competitors will adjust their packages, given that they now have information what the competition is doing. You should, at this point, already start determining how much you want to spend on compensation packages and what kind of mix of benefits to try to optimize productivity of the workforce. Financial performance is really important because you must make sure that you are not wasting any resources and you keep enough cash on hand so that you are not needing an emergency loan, and you have enough on hand, even with your 1 million that you add for Q4, to actually make decisions that combat your competitors' action. Firm performance is driven by firm profitability, individual brand profitability, regional profitability, net margins, which is the gross margin minus your cost for overhead, return on investment, asset management, how do you utilize your assets, and of course, sales channel profitability. These are individual analysis that you have to do to make sure you give feedback to your functional managers. Goals for your financial management are, of course, that you want to discover which brands and sales outlets are making the greatest or the weakest contribution to the bottom line. And as you do the analysis, you then, of course, will have to redeploy your resources to correct for weaknesses and enhance strong performance. We talked about production, the razor's edge, if you recall. It's the difference between high production runs and low production runs. Let's talk a little more about push versus pull marketing. You learned about push manufacturing versus pull manufacturing in other classes. And in push manufacturing, you try to build a forecast. That would mean that your forecast should be pretty accurate, and the probability of wrong forecasts are equal to 100% in the simulation. You simply cannot know for sure which brands will be in demand, and some have too much demand, which means you have stockouts and ill will. Some others will have too little demand, and that means you have excess inventory. So you might be consuming large amounts of cash because of your miscalculation in demand. So let's look at a different way to produce. Let's look at pull manufacturing. Pull manufacturing is basically building to order. While you want to forecast total demand, you do not really worry about the forecast for each brand. Mix of brands is not important because you have changeovers and you can do production runs. Results in far less stockouts and ill will, in far less ending inventory, and probably also in less use of cash. So in pull manufacturing, there are a couple of tough things to comprehend. You can offer multiple brands if you're uncertain about what customers want. So let the market decide. The brands that are in high demand will be pulled out of the warehouse, and because they're pulled out of the warehouse with the appropriate replenishment levels, you will produce them more. It makes actually sense to send workers home rather than build on inventory. So if there are certain brands that are not really demanded and you have not enough demand overall, because you have pull manufacturing, you're having to pay your workers, but it's probably cheaper to just pay them than having inventory, production on inventory that costs you an arm and a leg to carry, and you probably have to sell it off at a cheaper price since brands develop further. When you do pull manufacturing, you really need to look at lean manufacturing, making sure that you produce as lean as you can. And for lean manufacturing, the changeover is key. Long changeovers add substantially to the cost of production. And of course, they encourage long production runs. And that means you're actually, while you're reducing your production cost, you're producing an inventory, which we said many times before cost money. So they're increasing the probability of stockouts because you might be having a long production run on a brand that prohibits you from creating product for another brand that is in current high demand. And so the problem with having changeover is that it actually has a potentially negative impact on customers, since you would make more customers happy if you produced the right brand for customer demand. But if it's not the case and your long production run is on a brand that is not highly demanded, in the end, you're creating ill will. What you really want to do is you want to create mass customization and an ability to build any brand that is in demand without worrying about your changeover. So how can you do that? You try to drive down changeover time and changeover cost. That means you increase the effective capacity because a plant can produce almost all day, every day. That increases your fulfillment rate, which increases your sales, and of course increases your cash flow. By having brands available at all times, you have happier customers as they have a greater selection and word of mouth is positive. You have to invest, and I strongly encourage you to invest in R&D for changeover. There's another aspect, and that's quality control. The reliability of your production process means that your product coming out is of high quality and reliable in high quality throughout. Warranty costs, they are taking money out of your pocket. Not only are customers are sending back the computers for you to fix it, but it's also a negative word of mouth. So if you do a quality control program, you probably have to do it multiple quarters to significantly improve quality because there are multiple steps involved. I highly encourage you to start with that as soon as you can, because in the end, when we have the real big demand in Q2, it will pay off. So the steps in the quality control programs are: number one, you need to invest in inspections. Fix problems before they get shipped. You can do that in Q4. Do a variance study. Discover how bad the problem actually is. And then later, do a source study to find causes and solution of the problems, as well as step 4, try to implement actions to improve quality. Invest to reduce unwanted variance. That will be Q5 and beyond. Yeah, as I said before, it's easy to postpone, it costs money, and you're busy with lots of other things right now. However, inspections and system fixes can be expensive. Therefore, try to build a differential advantage by having a highly reliable production process and therefore creating happy customers who buy more and pay more because you have a differential advantage. Last but not least, let's look at the overall strategic management. You need to do a competitor analysis as well as a SWOT analysis where you compare your strengths and weaknesses with the opportunities and threats in the marketplace so that you can take corrective actions and control measures to combat competitors' actions. Remember, you have to be in sync between your overall strategy and your tactical decisions. Make sure that in your meetings, in your team meetings, before you make your decisions, you are rechecking that your strategy is in sync with your tactics. The learning points for Q4 are: number one, that you learn the management of strategy. You learn from your customers, competition, employees, and through financial information how to skillfully adjust your strategy and tactics. Secondarily, you also learn how to manage resources. Using the tools of management that are provided in the simulation, that would be accounting reports, industrial financial benchmark reports, human resource reports, market feedback, as well as profitability analysis, will actually lead to you making decisions that are financially sustainable for your firm and hopefully improving your competitive positioning in the marketplace.